Score. Hey, so we're going to talk about today on Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast, what makes a good credit score. And I have some excellent points to talk about with you today. So before we get into that, thanks for joining me. I'm really excited. Today's episode 127. We had the Bank of Canada also keep rates steady yesterday on March the 8th. So what makes a good credit score? Well, a good credit score, if you know, you know. But typically, a good credit score is around 700 points. And also, in Canada right now, if you have access to your credit score through either Credit Karma or any other of those free apps, another one is Mogo, there's actually two other scores that don't show on that app. In Canada, Equifax and TransUnion now come up with multiple scores. For Equifax, there's actually 3 different numbers that I see as a mortgage broker when I'm evaluating your credit file. So I will see your beacon score. That's number 1. That's your main score that we talk about, most companies talk about as being the minimum. But there's 2 other scores involved on your credit bureau, and those are an Equifax credit risk score, and there's also a bankruptcy prediction score. So those are 2 other scores I've been seeing a lot of lenders now use to adjudicate their applications. So believe it or not, if you have a good Credit Karma score, that's not the only score that you need to look at. All right. So what else is a good credit score? Well, credit scores, and why is it? Well, credit scores are used by lenders, other financial institutions. They're used to determine your credit worthiness, the likelihood that you'll repay the loan or the mortgage or the credit card balance on time. So there's a few factors that actually contribute to making a good score. So let's take a look at these right now. I'm going to get into these right now with you today. One of them, first one, is payment history. Now, payment history is probably the most important factor in determining your credit score. And how do you show the credit reporting bureau that you're good at your payment history? Well, one thing is crucial, and that is making your payments on time. And as long as you make your payments on time, each payment you make will contribute to a good score. And every payment you make will go into your history to show, you know what? This client paid their credit balance on time. When I look at a credit file, I can see every single payment this person has made, sometimes for 2 to 3 years. So if you've missed a payment 18 months ago, it's going to show on your credit bureau. And if it shows on your credit bureau and you're going to get a mortgage or a home equity line of credit, the lender or bank will want to know what happened at that time 18 months ago. Why is that? Well, they want to know what the reason is, specifically to help them determine whether or not they are going to approve your mortgage or loan or line of credit. It's very important, and a very good reason is needed to offset that risk. The worst thing you can do to move forward with your credit application at that time is to say, you know what, I just lost track and I don't know what happened. You need to know what happened, and you need to have a reason. So if you need to talk to a mortgage broker to put together your story, I'm always available. You can book an appointment with me in the video description link below. All right. What is the second factor in credit the one that maintains or constitutes a good score? Well, the second factor in what makes a good credit score, keep in mind we're talking about this during March, this is National Credit Education Month, would be the amount of credit you're using compared to the amount of credit available to you. That might sound contradictory. Why should not I use the full amount of credit available to me? If the bank has approved me for $20,000 on my Visa, I should be able to turn around and spend $20,000 on my Visa. If so long as I can make the minimum payments, why can't I use the full $20,000 on my Visa? Well, the bank doesn't care. The bank's going to love the fact that you're using $20,000 on your Visa. As a matter of fact, if you have 19.9% interest, the bank's going to love those minimum payments coming in forever. You're never going to pay off your balance. So what you're going to need to do to maintain a good credit score is to keep the amount you're using much lower than the balance. Because what happens if you're using your full balance, your credit score actually starts to go down. The credit reporting agencies start to minus off points. They start to decrease your score every month because they see credit cards as a temporary loan. And if you used that balance for 3-4 months, you're going to start seeing your credit dip significantly. You could go from having a 900 perfect credit score and having a max balance on your card. Just for 3 or 4 months, your credit score could dip into the 600s. That's below the 700 that is needed to get the best mortgage terms, mortgage rates, and mortgage funds. So how much credit do you need to use? Typically, you need to keep under 30% balance versus your limit. And that is your credit limit. So credit limit being $20,000, you're going to need to maintain 30% of that as your balance or less. So that works out to, maybe $7,000-ish. I don't have a calculator right now, but keeping your credit balance at $7,000 or less will actually maintain your score and help continue to build it going forward. What a lot of credit card companies will do if you're using a lot of your credit, say if you use the full $20,000 but do pay it off right away, they will send out a limit increase notice saying, we've approved you for a higher limit now that we've seen you've paid off your balance in full, and we've seen also that you've used quite a bit of your credit limit. So to help you, they'll actually increase your limit to make sure that you're not using 100% of it. Other things that happen when your limit is fully used is that you have the possibility and chance of actually exceeding your credit limit. And what happens when you exceed your credit limit is you get charged over limit fees and your credit score dips immediately because of that. And you don't want that to happen ever. You never want that to happen, because if your credit score dips immediately, you're going to need to rebuild that over the next few months to get it back up to where it was before. If you also go over limit, your over limit is registered on your credit bureau, and the lenders will see how much you've gone over limit on that account and when that was, month and year. And sometimes they will ask about that over limit if it was recent. A lot of mortgage lenders specifically are concerned about over limits within the last 24 months. All right. That leads me into my next section of this program, and that is the third thing that makes up a good credit score, and that is the length of your credit history. You might be thinking, why does the length of my credit history matter? I just got a credit card. That must mean I'm good for the mortgage. Well, if you've just got a credit card, typically your score does go down a little bit when you apply for a credit card, maybe 10, 20 points. Also, there will be no history there for the lender to decide whether or not they should give you a mortgage. They are going to want to see history of your credit card, especially if you've gone through a consumer proposal or bankruptcy in the past. The longer credit history that you can have, the better it can contribute to a higher credit score. Also, if you're showing full 2-3 years on each credit card and line of credit and car loan that you have, that's going to be the most reliable source. If you have never had credit before, it's important that if you have goals of buying a house in the future, that you get a credit card right away and start building your credit history. And don't just get the credit card approved and put it on your desk and never use it. You need to use it at least once when you first get it to activate the credit reporting. Otherwise, what do I see for folks that have a credit card that's laying on their desk that's never used? It will show that it's never been used and that we cannot count it towards your score. It'll actually show a 0 for score. So just because you've been offered that credit card doesn't mean it's contributing positively to your score. Okay, that brings me to number 4. What's the fourth thing that makes a good credit score? And that is actually a credit mix. Having a mix of different types of credit can help boost your score. I've seen my clients have excellent scores in the 800s, and it's not going to go up further. And why is that? Well, there's not enough of a mix. And what kind of mix are we looking for? We're looking for a mix of credit cards, unsecured lines of credit, home equity lines of credit, mortgages, vehicle loans, and store credit cards. You don't have to have a balance on any of these, but you have to have used them at some point and maintaining the account and keeping it open. Now, having a credit mix like this will boost your score so long as you're on time and following those other advices that I've given you already in this program. It's important to make sure that you have this credit mix so that you can maintain a good score and build good credit. If you don't have a car loan, but have the other credit scores, credit accounts like credit cards and mortgages, you don't necessarily have to have a car loan. It will say on your credit bureau that there's no installment loans to rate you by. However, your credit score can still be over the 800s. So don't go out running out buying a new car thinking that this is an excuse to buy a new car on credit. Number 5, new credit. Do you think this is a good thing or a bad thing? Well, new credit, actually opening up many new credit accounts all at once, can lower your score. Yes, even though you're being approved for all these credit accounts, it can actually lower your score. So it's important to be selective about when, how often, and where you apply for credit. It's important to have new credit because it shows that companies and lenders and financial institutions are extending credit to you. However, it's important to keep a slow pace in doing so. Overall, a good credit score is important for accessing credit, getting favorable terms on loans, other financial products. And by being responsible with your credit, making payments on time, you can build and maintain a good credit score. Some hacks that I will suggest that you can take home today to help maintain and build a good credit score on autopilot are: 1, pay off your credit card balance before the statement date and not the due date. The statement date comes a few days before your due date and will actually issue a statement to you with a zero balance due. And because of that, will actually show a lower balance, zero balance on your credit bureau. If you're paying your cards by the due date, it's the due date balance that shows on your credit bureau. So if you pay off your $5,000 credit card by the due date, it's actually going to show that you're maintaining a balance of $5,000 on your credit bureau, which will lower the amount you can afford on the mortgage. Second thing is, if you're using a card and you're using it often, every month or every 2 weeks or every week, is to go into your banking and set an auto payment to pay that account and pay that bill every week or every 2 weeks or every month, and throw down more than what the minimum payment would be. So long as you're doing that, you'll never miss a payment. And all you will be responsible for is making sure the balance is paid off for whatever balance you have. As long as you're doing the minimum payment, you'll never miss that. Excuse me. And the third hack, and it seems simple, but then again, a lot of people don't do it, is to open your mail. Open your mail from your credit cards, because some credit cards have an annual fee. And the last thing you want to have happen is that a credit card statement comes in the mail and you've missed that annual fee, and that you're not able to pay off that credit card that month, and it all of a sudden registers a late payment on your score. Also, open your mail, because if you've paid off a balance on your line of credit, credit card, or home equity line of credit, quite often there's still interest outstanding for the next billing cycle, depending on when you've paid off that balance, because it's calculated daily. So just because you pay off your balance today doesn't mean you will have no balance tomorrow. It means that you need to pay it off and keep track of it. So open your mail. I've seen clients just pay it off, put the other statements aside, and never really realize that they had a $1.12 balance left on their credit card of interest accrued from the previous month. And that can ruin your score. All of a sudden, you're applying for a car and you're wondering why you're getting such a high rate, or you're applying for a mortgage and your broker's calling you and saying, you have 12 missed payments on your Visa here. Oh, I didn't know that there was an annual fee. Oh, I thought I paid off the balance. Make sure you monitor that. All right. So those are the 5 main aspects of what makes a good credit score. So that again is payment history, credit utilization, length of credit history, credit mix, and new credit. On another episode, I'll cover off how to rebuild your credit score and start from scratch after a consumer proposal or a bankruptcy, but this is not the episode to do that. What I'd like to do on Canadian Mortgage Weekly, Canada's only video mortgage news podcast, is just to cover some of these news items, As you see, I have here a typical $500,000 purchase illustrated with a 5% down payment, showing a $2,700 monthly payment on the mortgage. Refinancing an existing home, say if your home was worth $900,000, you're looking at a mortgage payment of $3,950. What's been happening with the bond yield? And why do I follow the 5-year bond yield? Well, the 5-year bond yield I follow simply because I like to predict and be ahead of the curve when my clients are asking me about fixed rates, what's going to happen. Well, when the 5-year bond yield was dropping at the latter half of 2022, we did see fixed rates dropping. As you see, this black trend line shows the trend going down. Now, we did bottom out here, and this was a good time to get pre-approved. Any of my clients got pre-approved here got a rate that is about 1% lower than what it was here. And now we're looking at a higher bond yield, and looking forward, it could continue to go up further. We'll have to see. We'll keep an eye on it here on Canadian Mortgage Weekly. Another thing that we follow is the Canadian inflation rate, currently sitting at 5.9%. Right now, the Canadian inflation rate sitting at 5.9%. We do see it trending down, as noted by this red line. We will receive February numbers around March 20th. So stay tuned. That will be in approximately 2 episodes. I'll have an update on that. The American inflation rate's also been trending down. However, it kind of have stagnated here for December and January. We'll have to see what happens going forward for American inflation. Currently at 6.4%, it's higher than it is for Canadians. Okay, the CDOR rate, maintaining steady at just over 5%, bringing the variance to prime at 6.7%. We did see it increasing quite significantly from April through July into October, and then flattening off since January. This is a metric I use to determine whether or not the variable rate mortgage is competitive. And currently, with the variance being so little to prime, it is not competitive because this is what the banks base their variable rate mortgages off of. Jobs report. When we did see this spike down in jobs in 2020, the Bank of Canada lowered rates considerably. Since then, we've seen an increase in jobs, so much so that we saw another increase of 0.8% in January of 2023. How will this work out next month? We'll have numbers in about 2 weeks. But jobs, so long as jobs are increasing, we should not assume that rate hikes are over. As a matter of fact, 𝗪𝗂𝗏 did make comments yesterday about leaving the door open to future rate hikes if job numbers continue to climb. It's the unemployment they want to see to lower rates. Prime rates currently sitting at 6.7%. It's maintaining steady. We have prime rate maintaining 6.7% as of yesterday's March 8th rate announcement. The next rate announcement is on April the 12th. April the 12th, what do you guys think will happen? Current overnight rate sits at 4.5%. April the 12th, I'll have another pre-rate show to go over with you guys for the Bank of Canada interest rate update. All right, house prices. The national average house price has gone down 2% in January of 2023. Currently sitting at $612,204. We'll have to see if it continues to go down. It's been going down ever since February of 2022. We did see a slight increase here from July to October, but since then, small declines every month. Not very much difference here. We'll have to see and wait. All right. That makes the average national house price down payment $36,220.40 if you're putting the minimum down, making the monthly payment $3,281.43. If you're a renter and you're wondering why rents have gone up, well, it's just costing more for people to buy and hold these houses. So for them to rent them out, they can't rent them for less than this. You need to add property taxes. You need to add maintenance costs. So rents are going up specifically because house prices have gone up and interest rate prices have gone up. So just to get a house costs more money each month, and it costs more money to get in. And if you're buying a rental property with 20% down, $180,000 is the down payment. $2,684.41 is the average monthly payment on that rental property. So rents aren't going back down anytime soon. Matter of fact, they will continue to go up so long as interest rates are going up and so long as house prices remain high. There's no possible way landlords will be able to afford renting their house out for less money. And if the rents can't go up, the landlord will simply just sell the house. And a lot of new Canadians are coming in each year to Canada, taking these rentals over and buying them as their own principal residences. So it's actually taking a lot of rentals off the market, pushing rents up further. So that'll be an interesting conundrum that we will see in the next few years. In the meantime, thanks for watching. This has been episode 127 for Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast. If you have any comments, leave them below. Send me an email or book an appointment with me through the appointment link in the video description below. Looking forward to working with you. And if you're looking for some credit advice, please reach out. Be happy to go through your credit.